Welcome back to the Babalian Money Show, your go-to place for smart investing strategies. In today's volatile market, everyone's asking the same question: how can I protect my money? Well, you've come to the right place. Today, we're diving deep into how to make your portfolio more defensive. We're going to explore actionable strategies to shield your investments from market downturns without sacrificing long-term growth. Before we jump in, a quick disclaimer. I am not a financial advisor, and this video is for educational purposes only. Investing involves risk, and you should always do your own research or consult with a professional before making any financial decisions. Your financial situation is unique, so treat this as a guide to help you ask the right questions. So, what exactly does a defensive portfolio mean? It's not about hiding your cash under the mattress. It's about building a resilient investment strategy that can withstand economic shocks. Think of it like building a house. You don't just want it to look good. You want it to have a strong foundation that can handle storms, earthquakes, and whatever else nature throws at it. A defensive portfolio is your financial fortress. The first and most crucial pillar of a defensive strategy is asset allocation. This is the big one, folks. It's how you divide your investment capital among different asset categories, like stocks, bonds, and cash. During bull markets, it's easy to get carried away and go all in on high-growth tech stocks. But when the tide turns, those are often the first to sink. A defensive allocation involves increasing your exposure to less volatile assets. Let's start with bonds. Government bonds, especially those from stable countries like U.S. Treasury bonds, are often seen as a safe haven. When the stock market panics, investors often flock to bonds, which can drive up their value. They also provide a steady stream of income through interest payments, which is a nice cushion during turbulent times. Now, bonds aren't completely risk-free. They are sensitive to interest rate changes. But in a major market downturn, high-quality government and corporate bonds have historically held up much better than stocks. Next, let's talk about the stocks part of your portfolio. Going defensive doesn't mean selling all your stocks. It means shifting your focus. Instead of speculative growth stocks, you want to look at what we call defensive sectors. These are industries that provide essential goods and services people need regardless of the economic climate. Think about it. Even in a recession, people still buy groceries, use electricity, and need health care. So, which sectors are we talking about? The big three are consumer staples, utilities, and healthcare. Companies in the consumer staples sector sell things like food, beverages, and household products. Think of brands like Procter & Gamble or Coca-Cola. Their sales tend to be very stable. People don't stop brushing their teeth just because the economy is weak. Then you have utilities. Companies that provide electricity, gas, and water are classic defensive plays. They often operate as regulated monopolies, which gives them predictable revenue and the ability to pay consistent dividends. When other companies are struggling, utility stocks can be a reliable source of income. And finally, healthcare. Similar to consumer staples, demand for healthcare services and products is relatively inelastic. People get sick and need medicine or medical care no matter what the stock market is doing. Large pharmaceutical companies, medical device manufacturers, and health insurance providers often perform well during economic downturns. So a key defensive move is to rebalance your stock holdings. Reduce your exposure to cyclical sectors like technology, consumer discretionary, think luxury goods and travel, and industrials, and increase your allocation to these defensive sectors. This doesn't mean you sell all your Apple or Amazon stock, but maybe you trim those positions and add shares in a utility ETF or a healthcare giant. Another powerful tool in your defensive arsenal is dividends. Companies that pay regular, sustainable dividends are often mature, financially stable businesses with strong cash flows. These dividend payments provide you with a regular income stream, which can be a lifesaver when stock prices are falling. That cash can be reinvested to buy more shares at lower prices, a strategy known as dollar cost averaging, or it can be used to supplement your income. Look for dividend aristocrats or dividend kings. These are companies that have a long history of not just paying, but consistently increasing their dividends for decades. This track record is a strong signal of a company's financial health and management's commitment to shareholders. A portfolio rich in dividend-paying stocks from defensive sectors is a powerful combination for weathering a market storm. Now, let's not forget about cash. In the investing world, cash is often seen as boring. It doesn't grow like stocks do. But in a downturn, cash is king. Holding a portion of your portfolio in cash or cash equivalents, like high-yield savings accounts or money market funds, serves two purposes. First, it acts as a buffer, preventing you from having to sell your stocks at a loss to cover unexpected expenses. This is your emergency fund, but for your portfolio. Second, it gives you dry powder. When the market eventually bottoms out, and it always does, you'll have the capital ready to deploy and buy quality assets at bargain prices. The biggest fortunes in investing are often made by being greedy when others are fearful. And you can only do that if you have the cash on hand. Don't underestimate the strategic value of liquidity. Beyond these core strategies, there are other assets you can consider for diversification. One is precious metals, particularly gold. Gold has been a store of value for thousands of years and often performs well during times of economic uncertainty and inflation. When investors lose faith in currencies or the stock market, they often turn to gold as a safe haven. It doesn't pay a dividend, but it can act as a form of portfolio insurance. You don't need to go crazy and fill your basement with gold bars. A small allocation, say 5% of your portfolio, through an ETF can provide a good hedge. Another area to consider is international diversification, but with a defensive tilt. Investing in developed markets outside of your home country can reduce country-specific risk. Look for stable economies with strong currencies. For example, some investors look to Swiss or Japanese markets for their defensive characteristics. So let's recap the game plan. First, review your asset allocation. Increase your holdings in high-quality bonds and reduce your overall stock exposure if it is too aggressive for your risk tolerance. Second, within your stock portfolio, rotate from cyclical growth stocks into defensive sectors like consumer staples, utilities, and healthcare. Third, prioritize companies that pay stable and growing dividends to provide you with a steady income stream. Fourth, maintain a healthy cash position to act as a buffer and to seize future opportunities. And finally, consider adding alternative assets like gold for an extra layer of protection. Building a defensive portfolio is not a one-time event. It requires regular monitoring and rebalancing. As market conditions change, you may need to adjust your allocations. The goal is not to eliminate risk entirely. That's impossible in investing. The goal is to manage risk in a way that allows you to sleep at night, even when the market is having a nightmare. It's about being proactive, not reactive. The worst time to try and make your portfolio defensive is in the middle of a market crash when panic sets in. The best time is now, when you can think clearly and strategically. By taking these steps, you're not timing the market. You're preparing your portfolio for whatever the market throws at it. You're building a financial plan that's built to last. And that's our deep dive on how to make your portfolio more defensive. I hope you found these strategies helpful and empowering. Remember, the key is to build a portfolio that aligns with your personal financial goals and your tolerance for risk. If you got value out of this video, please do me a huge favor and hit that like button. It really helps the channel grow and reach more people just like you. And if you haven't already, make sure to subscribe to the Babalian Money Show and ring that notification bell so you don't miss our future videos on smart investing and personal finance. We have a lot more great content coming your way. Thank you so much for watching, and I'll see you in the next video. Stay safe and invest wisely.